Welcome to Alpha Insights. I'm Ryan. Today we're parsing NVIDIA's big quarterly report and, more importantly, a quieter shift under the hood of AI data centers that could make certain suppliers winners no matter which way the earnings print goes. With me is Jessica, who follows networking and optical supply chains closely. Jessica, great to have you. And remember, if you have questions as we go, you can ask us at stockalpha.ai.
Thanks, Ryan. Good to be here. NVIDIA will, of course, grab the headlines today, but there's a parallel story: the move from copper cabling to optical interconnects inside and between data centers that looks like a multi-year structural trend.
So, the real question here is, how should listeners think about the difference between the short-term earnings reaction and this longer structural shift?
Short-term, earnings matter a lot. If NVIDIA beats expectations, we usually see a near-term risk-on move. Hyperscalers accelerate orders, AI hardware stocks jump, and optics demand can spike. If NVIDIA disappoints, that can trigger a sharp sell-off across AI-related names. But medium-term, hyperscalers are planning multi-year builds, and they need higher speed, lower power links. That almost always points to optics over copper. Yeah. I mean, when you look at the data, the scale is meaningful. Light Counting expects the optical interconnect market to grow from roughly $5 billion to about $10 billion in 2026. And industry estimates put hyperscaler capital spending at more than $600 billion this year. Those two together create a big runway for optical suppliers.
Right. That's huge. Who are the obvious beneficiaries if this shift keeps accelerating?
There are a few categories: big, diversified photonics and laser vendors with scale and broad product lines. Suppliers focused on lasers and transceivers that are sensitive to higher speed modules. Contract manufacturers that win when volumes rise. And silicon and switch vendors that sit behind the optics. For example, Coherent is known for lasers and photonic subsystems across telecom and data centers. Lumentum supplies lasers and optics and is exposed to the move to 400 gigabit and beyond. Fabrinet is a contract manufacturer that benefits from higher volumes and complexity. Marvell makes chips used inside switching fabrics and optical modules, so it tends to do well as networking ramps. And then there are smaller, early-stage names like POET Technologies.
Interesting.
POET is worth calling out because it recently won a Lightwave Innovation Award and announced a production order for a little more than $5 million for 800 gigabit engines. It also has a cash position north of $300 million, which gives it runway to try scaling. So it's an attractive speculative play, but it's still early revenue stage and carries execution risk.
Got it. What are the main risks investors should be watching?
There are several. One is cyclical risk. Enterprise and telecom CapEx can slow. Two is competition and consolidation. Big cloud providers can vertically integrate or negotiate tough terms. Three is technical. Next-generation photonics can be hard to integrate, and yield can be a challenge, especially for smaller players. And finally, macro shocks or an unexpected NVIDIA miss could pressure optics names in the short run.
Okay, practically speaking, what should investors do if they want exposure but want to manage risk?
First, know your time horizon. If you want lower execution risk, lean toward larger incumbents with scale and diversified end markets. If you tolerate volatility for higher upside, a small name like POET could be interesting, but size positions accordingly. Watch three signals: hyperscaler CapEx guidance and public order announcements, transceiver shipment trends, especially adoption of 400 and 800 gigabit modules, and customer wins or production milestones. Also track margin trends and whether contract manufacturers are seeing rising utilization. Those are early indicators demand is real and sustainable.
Yeah, that's a good point.
One practical note: earnings days like today are noisy. A strong NVIDIA number can lift optics in the short term, but if the broader secular drivers are intact, dips after bad prints can be buying opportunities for long-term investors. On the other hand, if you're trading the print, be ready for big intraday moves and manage position size. Honestly, I was a bit surprised by how quickly some hyperscalers moved from talking about optics to putting it into production plans. That pace matters because it compresses the timeline for suppliers to scale manufacturing and improve yields.
Right. Before we go, can you give listeners 2 or 3 quick takeaways?
Sure. 1. NVIDIA's earnings will move sentiment short term, but the copper to optical shift is a longer term structural story. 2. Watch hyperscaler CapEx, transceiver adoption of 400 and 800 gigabit, and production wins. Those are the clearest signals of durable demand. 3. Pick exposure based on risk tolerance. Incumbents for lower execution risk, early stage names for higher upside and higher risk.
Perfect. Those are actionable. Thanks, Jessica.
Thanks, Ryan. Pleasure.
If you have questions about anything we discussed today, you can ask us directly at stockalpha.ai. We answer listener questions live. And for more market insights, head over to stockalpha.ai.